If you're considering purchasing a second home or an investment property, stay tuned because I'm going to dig deep into the nuances from a home loan perspective. First and foremost, know that when you go through the home loan pre-qualification process, the lender is going to want to know what your true intent is with the property. And intent is important because it will drive the home loan classification. For example, if your intent is to purchase a home that you're going to vacation in and spend some time in that home during the year, and maybe when you're not vacationing in the home, your intent is to rent it to family or friends or potentially even on Airbnb or VRBO. If that's your intent, then a second home property classification could be a good fit for you. If your intent is to purchase a property and put a long-term tenant in it and start to build wealth through that real estate, that becomes more of an investment property type of home loan classification. Now you might say, well, what's the difference? There are differences based on the home lending guidelines, two of which are on a second home, you're allowed to put as low as 10% down, whereas on an investment property loan, you have to put a minimum of 15% down, but generally we see investors putting 20, 25, or 30% down. And the reason for that are the terms of the home loans in both scenarios improve with more money down. So if you're an investor and looking to invest on a long-term buy and hold type of strategy, many times we're seeing at least 20% down to avoid mortgage insurance and to get better terms. That 15% down investment property pricing is ugly. So we just don't even see it really come into the conversation. But it is important to know that it exists. Outside of the down payment difference, the second difference is the seller credit. The allowable seller credit is going to vary based on the home lending guidelines between a second home and an investment property. On investment properties, the max is 2% seller credit. Doesn't matter the down payment. When we look at a second home, the seller credit is going to vary based on the down payment and could be anywhere between 3 and 9%. So while we start to think through down payment and potential seller concessions, it used to be that there was a big interest rate or cost difference. But that kind of changed a couple years ago when Fannie Mae and Freddie Mac changed the lending guidelines and changed what we call LLPAs or loan level pricing adjustments associated with the second home. So prior to that change, pricing, and by pricing I mean interest rate and cost of the home loan, really was aligned more with primary residences versus investment properties. But since that change, which occurred a couple of years ago, now when we look at interest rate in terms, second homes price more closely to an investment property type of interest rate and term pricing. Now, there are some really cool things happening out there. One of which is we're seeing programs come to market that actually fill the gap, meaning that Fannie Mae and Freddie Mac, which are conventional conforming home loans, because of those loan level pricing adjustments, there isn't much of an incentive for second home property classifications other than what I said, the closing cost credit availability and the down payment. But outside of that, when we get into interest rate and terms, they're more closely aligned. Well, these programs are a solve for that. So if you're working with a lender and going through the process and they don't have alternative home loan programs that can solve for better terms in certain situations, again, it's not just one size fits all, but based on credit score and down payment and property classification, we're seeing that there's this whole new uprising of programs out there that can offer better terms than the traditional Fannie Mae, Freddie Mac second home approach. So if that's you and you want to inquire about the details on these programs, if you're purchasing a second home or an investment property, please click the link below and schedule a 15-minute consultation with the KellyZtilowGroup mortgage advisor. We'll kind of dive deep into the nuances, what your intent is, how you envision holding the property, etc. And then we can start to design a program around those goals. One of the additional differences from a lending standpoint is that if somebody's purchasing an investment property, many of the lending guidelines allow for a certain percentage of the projected rental income to be calculated into the debt to income ratio, whereas back on a second home type of property classification, that is not the case. So when I say there's so many different nuances, there really are, and what's important is to have a detailed conversation about your goals with an educated lending team that truly understands the right questions to ask and that can walk you through a structure that helps you achieve your goals. Again, if this sounds like an area you want to explore, click the link below and we'll get you started. Thank you so much for watching. This truly is a passion just to share information and break down barriers to home ownership, no matter if this is your first home or if this is your 5th or 6th or 10th or 20th, or a vacation home or an investment property. It is important to us to bring information out to the communities across the country. So please subscribe and share to anybody you know that you think would benefit from this content.